For last year, the S&P 500, we say the U.S. large Fortune 500 when we say the S&P 500. It was up about 13.5. Bonds yields were about 2.17. Gold had lost money, and emerging markets lost money. Here's a little broader perspective, but the winner last year was U.S. stocks by a strong measure over everything else that you might put into a diversified portfolio. International stocks, we'll show you a little bit more on that, actually went down. And there's two types. There's what we call developed countries like Europe, and then you have emerging markets, which are the more of the Asian type countries, India and China, that grow faster, that have better potential but a lot more risk. Both of those were down. And then Treasury bonds, the yield went down further. We're going to talk, that surprised us, it surprised me, because we've been talking for 2 years that yields were going to start going up. And they started in 2014, starting to go up, and I was going, here we go. So last year, January this time, it's like, I think we're about 3% yield. So when bond yields go down, the bond price goes up of existing bonds and vice versa. And so it's like, how much lower can these things go? But you're going to see commodities. We had a big crash in. Large caps did well. Smaller stocks not as well. Lost money in the emerging and international stocks. Bonds did okay with their principal gains because the yields went down. Treasuries were yielding very little in there. So it made kind of a year of a wider spectrum between winners and losers.